Good morning. Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live from the Nasdaq Felix Options trading floor. Joining me for this segment is Feinour, who's a securities attorney with Stradley and Ronon, and we're going to get a perspective from the legal end with the proposed SEC ETF rule. Thanks again for joining us.
Thanks for having me once again,
Felix. And so it's really interesting when we can get the regulatory perspective. Usually we have traders on, asset managers, and so forth. The proposed SEC ETF rule. What is that all about?
Yep. So I feel like the last time we were in here talking, we were talking about spoke about the potential for an ETF rule, and right on cue, SEC at the end of June proposed a rule. The proposed rule would establish a consistent regulatory framework for ETFs by rescinding most of the ETF exemptive relief that's been issued over the last 26 years, which had some variations in terms and conditions. The rule would cover most ETFs that are registered as investment companies under the 1940 Act. It would not cover share class ETFs, that's specifically the Vanguard ETFs. It would not cover leveraged ETFs. It wouldn't cover ETFs that are structured as unit investment trusts, which is a structure utilized by some of the earliest ETFs like SPY. So all of those different types of ETFs would continue to rely on their existing exemptive relief. Notably, the rule would also not cover less transparent active ETFs. To date, those have not yet been approved by the SEC, and so they wouldn't be part of the rule either.
Does this have any impact on investors?
Yeah, so I think so. I mean, a few key takeaways from the proposal. I think the biggest thing is custom baskets. So creation and redemption baskets are the in-kind baskets of securities and assets that authorized participants use to transact directly with the ETF for large creation unit aggregations of the ETF shares. Generally, those baskets are required to be a pro rata slice of the ETF's portfolio. Earlier entrants into the ETF space, they had more flexibility with respect to basket construction in the instances where they could deviate from a pro rata slice than more recent entrants, which is a competitive advantage for those earlier entrants. The rule would level the playing field with respect to custom baskets and give that flexibility to all ETFs that could rely on the rule. Why is this important? How does this benefit ETFs and their shareholders? The use of custom baskets allows an ETF to reduce portfolio transaction costs, to gain greater tax efficiency. It allows an index ETF to better track its index. On the AP side, custom baskets facilitate creation and redemption activity because smaller baskets are easier and cheaper for APs to trade. So it ultimately results in tighter spreads, lower premium discounts, and improved arbitrage. So it's a good thing for all, including investors.
So it sounds like it's going to create more competition, more innovation, so that investors have more choice as well.
Yeah. So it's certainly. I mean, the current process for ETF exemptive relief, issuers have to go in and obtain this individual exemptive relief from the SEC. That's they will no longer have to do that. They could rely on the rule. So it's going to be a little bit easier to come to market. There are also some other notable regulatory kind of developments that are baked into this rule. One is that the distinctions between index and active ETFs is being removed. Currently, active relief and index relief is obtained through separate applications. And over the last couple of years, with the proliferation of smart beta strategies, that line between index and active is blurred. And so the SEC is coming in and they're removing that distinction. And there were previously different requirements that would apply to index versus active ETFs, and those are getting removed. A couple other things to point out would be there's going to be some new disclosures that are required around the bid-ask spread that the ETF shares trade on the secondary markets. That's designed to give investors more information about how the ETF shares trade on the exchange. Also, one other big aspect of it is the what's called the intraday indicative value, which is a per share approximation of the ETF, the value of the ETF shares that's disseminated frequently throughout the trading day. That requirement is being removed. So, when you pull this all together, industry reaction to the rule has been positive. It's been well received. The general consensus is that it's a well thought out and well crafted proposal. The SEC, in not tackling some of the different types of ETFs that I mentioned earlier, they were able to keep the rule relatively straightforward.
So it's in the proposal phase right now. When do you expect it to be enacted?
Comments on the proposal are due October 1st. So there's been some industry comment letters that have been submitted to date. There's going to be a whole flurry of them coming over the next 2 weeks leading up to that October 1st deadline. SEC will take that feedback and industry comment into consideration, which will inform their adoption of the final rule, which we're probably looking at sometime early to mid 2019 for a final rule. Which, I mean, there could be some differences that end up in the final rule as compared to what was initially proposed.
So when we're back here in June 2019, we should know at that point.
Yeah, I mean, hopefully earlier, but I think at this point it's it's a matter of when, not if. The rule proposal had the full support from the SEC commissioners, so it's been a long time coming, and it's something that people are excited about.
All right. Well, great to catch up with you. Thanks for joining us
Yep,
back
thank
in
you.
Philadelphia, and thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at